All right, welcome to this explainer. Today we're unlocking one of the most fascinating puzzles in the financial world. We're going to dive deep into acclaimed NYU finance professor Aswath Damodaran's frameworks. The goal? To demystify exactly how experts attach real, hard dollar amounts to the trickiest, most unconventional assets out there.
Let's kick things off with Oscar Wilde. You've probably heard this one before. He described a cynic as someone who knows the price of everything, but the value of nothing. And honestly, in the financial world, a surprising number of investors subscribe to what we call the dangerous bigger fool theory. They buy an asset without really caring what it's actually worth, just crossing their fingers that a bigger fool will come along later and pay a higher price. But look, a core postulate of sound investing is that you never, ever pay more for an asset than its true intrinsic worth.
And that brings us to the ultimate mystery we're tackling today. Because it's patently absurd to justify a price purely by saying someone else is going to pay it tomorrow, right? Now, sure, aesthetic and emotional perceptions might drive art buyers, but most financial assets are acquired for the cash flows they generate. So, if emotional perceptions aren't enough for a disciplined investor, how do we mathematically find the value of anything, from a towering Manhattan skyscraper all the way to a rare piece of cardboard?
Here's our roadmap for the explainer. We'll be looking at the core of valuation, valuing cash-producing real estate, the power of comparables, valuing art and collectibles, and finally, assets as real options.
Section 1. The core of valuation and its foundational approaches. Let's start at base camp and look at the core principles dictating financial worth across the board.
When it comes down to it, Damodaran outlines three big foundational models that pretty much every analyst relies on. First up is discounted cash flow, or DCF. This relates the value of an asset to the present value of its expected future cash flows. Second is relative valuation, which estimates value by looking at how the market is pricing comparable similar assets. And the third is contingent claim valuation. This one uses option pricing models to measure assets that share option characteristics, meaning the value is contingent on a very specific event actually occurring.
Section 2. Valuing cash-producing real estate, focusing on tangible assets. Let's anchor ourselves with something massive here: commercial real estate.
Okay, let's demystify some real estate jargon. You hear cap rates or capitalization rates thrown around all the time, right? Well, a cap rate is really just an inverse multiple. It directly links a building's expected net operating income prior to debt payments to its value. Think of it as the real estate equivalent of looking at a company's value to earnings multiple.
Now, you might wonder, how in the world do you compare a 500,000 square foot building on 3rd Avenue with an 800,000 square foot behemoth on 7th Avenue? Well, you standardize it. By breaking these massive properties down into standardized metrics, like price per square foot, occupancy rate, and net operating income per square foot, we can actually compare giant Manhattan high-rises mathematically. It takes all the subjective emotion right out of the brick and mortar.
Section 3. The power of comparables and relative valuation. But hey, what happens when an asset doesn't exactly hand you a steady stream of rent checks to discount?
Think about your own primary residence. An office building generates cash, so boom, we use discounted cash flows and cap rates. But your single-family home, it doesn't pay you rent, so you value it by looking at similar properties in your neighborhood. You might check the price per square foot of the house that just sold down the street. You're executing a classic relative valuation precisely because there are no cash flows to discount. It's a simple concept, but it's incredibly powerful.
Section 4. Valuing art and collectibles, which are completely non-cash flowing. Now we pivot into what I like to call the subjective Wild West. We're talking about assets that produce absolutely zero cash flow and rely entirely on scarcity and human perception.
The really crucial point here is the data story. Check out this historical index built by May and Moses. They analyzed repeated art sales all the way from 1875 to 2010. And it turns out, while art historically yields lower mean returns than the S&P 500, it has a surprisingly low, and sometimes even negative, correlation to the stock market. Because it doesn't just move in tandem with stocks or treasury bonds, art can serve as a wild, yet mathematically fascinating portfolio balancer.
But, and this is a big but, jumping into relative valuation for art requires a seriously expert eye. Why? Because you are battling some massive hurdles. First, there's extreme illiquidity. The last comparable Picasso might have sold 3 years ago in a totally different economic climate. On top of that, every single item is completely unique. Transaction costs are through the roof, and the ever-present threat of fraud means you could be dropping millions on a clever forgery.
Since there's no actual cash flow backing up the price, the value here is incredibly fragile. It literally relies on scarcity. Take the Hannes Wagner 226 baseball card. It's valued so highly primarily because there are only 58 known cards in existence and only one in mint condition. Just imagine the absolute market panic if someone suddenly found a pristine box of rare Hannes Wagner cards hidden in their attic. The supply balance shifts and the perceived value crashes overnight.
Section 5. Assets as real options and contingent value. Let's look out at the horizon for our final and honestly trickiest category, assets that produce nothing right now but hold massive future potential. Think about an empty dirt lot in a city, or maybe an unproven pharmaceutical patent. They aren't worthless, even though they actively drain cash through taxes or maintenance fees. Damodaran teaches us that these are actually financial options waiting to be exercised. When you buy undeveloped land, you're paying an option price. The flexibility to just wait for the right market conditions is where the true value lies. You might even buy land when the expected appreciation is low, simply because high market volatility means that if prices do surge, you can exercise your option and develop it for a massive profit.
Let's take a step back and look at how this builds our entire valuation framework. Every single asset you could possibly buy, whether it's a blue-chip stock, an untapped oil reserve, or, a vintage Barbie doll, it falls somewhere on this exact spectrum of marketability and cash flow generation. To wrap our heads around all of this, value essentially boils down to one of these three distinct realities. If an asset generates cash now, you discount those cash flows. If it might generate cash under certain contingencies, you use option pricing models. And if it will absolutely never generate cash, you have to rely entirely on relative valuation and comparables. So, keeping this entire framework in mind, I want you to take a hard look at your own investments. What is your portfolio truly built on? Are you holding on to tangible cash flows? Are you sitting on strategic real options, just waiting for the right moment? Or are you relying on subjective scarcity, just hoping a bigger fool comes along tomorrow? Thank you for joining me for this explainer, and I really hope this changes how you view the value of everything around you.